Hi, this is Mrs. McClutchy again, and this is part 2 of our savings and investment videos on what is the difference between savings and investment. We're going to be focusing on how they are different and what they don't have in common. So let's get started. Savings have high liquidity. Now, liquidity refers to the ability of an asset to be easily sold and converted into cash. Now, savings accounts, piggy banks, bonds, and fixed assets accounts, they are very easy to access. They are highly liquid. And you may need to liquefy your assets for different reasons. Firstly, you may need that money on hand for everyday purchases. You may need to have that as a buffer for emergencies. And so that's an advantage that savings has over investments, highly liquid. Investments, on the other hand, are harder to access. For example, if you were trying to sell an investment property, it could end up taking you months and months, and typically most houses take up to 3 months to sell. That's why I've got the picture of the skeleton there as a reminder to you that they are harder to access. It could take a long time to get hold of that important cash that you need. Even things like collectibles. You might have a vintage car. It could take a very long time to find somebody who's prepared to pay the price you're looking for your collectible items. The main exception is shares. Shares can be sold just like that, provided that it's between trading hours on a weekday. However, you may not get the price you're looking for the shares, so you may end up losing money if you had to access that money in an emergency. Hence, investments aren't really what you want for those short-term everyday purchases or for your savings buffer. Savings are better for that than investments. The other key difference is that savings are for working towards our short-term goals. And this is all about time horizon. A time horizon is the length of time that you plan on having that savings account or that investment for. So for example, if you're saving for a short-term goal to purchase a television, or perhaps your short-term goal is to buy a new computer or a new Xbox, savings accounts are best for working towards that. On the other hand, investment is better for our medium and long-term goals, such as buying a car or a house. Savings accounts have little to no risk. Now, there is a minimal amount of risk in a savings account. For example, if you had your money in a piggy bank, well, there's a risk you could go and spend it, or that your house could burn down or a thief could steal it. If your money's in the bank, there's virtually no risk. The government actually guarantees all your deposits in the bank. So if you have $1,000 in there, the government backs that and guarantees that when you go to withdraw it, it will be there for you. Investment, on the other hand, generally has higher risk. There is a good chance that you could lose not only any growth that you've had in that marketplace, but you could also lose your original capital. For example, if you were to purchase $1,000 of shares, and then there could be a global financial crisis like we've been experiencing in 2020 and also back in 2008, you could lose not only the $1,000 you've invested, but also any growth that those shares had made while they were sitting on the stock exchange. Savings, though, even when they have the low risk that they have, and as a result of that low risk, there is generally low return. And here is a graph of the cash rate in Australia over the last 20 years. As you can see, that's been declining in line with inflation in the country. And at the moment, in 2020, our return on a savings account is somewhere between 0 and 1%, which is not great money back. Investment, on the other hand, has the potential for much higher returns. Higher risk goes with a higher return potentially, but it's not guaranteed. So these are the capital cities in Australia and housing prices, for example, on the property market over the past 20 years. And as you can see, there's been ups and downs, but they've generally been on the growth curve. Now, if you were to purchase your house, for example, in Melbourne in 2010 and then needed to sell that in 2012, you would find that you'd actually have lost money. So it doesn't always guarantee there's going to be a higher return. But that's why we have a long time horizon for investment, because in the long term, there is generally a good return on things like property. Savings also have low volatility, and volatility refers to how changeable the price is. It's up and down, up and down, up and down. That would be high volatility. If you were to look at the stock exchange from day to day, it's all over the place, typically much higher volatility. And you can see this is a volatility index for the last 30 years for shares, and you can see that in Australia they've been all over the place, very unpredictable, whereas savings tend to be flatter. It all depends though on what's happening in the economy. At the moment, our Reserve Bank of Australia keeps lowering the cash rate, and that's in line with our inflation, and also to try and stimulate more growth in the economy. So it's not as stable in the savings market as it would have traditionally been. However, it typically still has a much lower volatility than, for example, shares. So here is a Venn diagram showing you what they have in common, which is ways that they make money grow and obtain rewards. And then on the left-hand side, you can see all the differences with savings, and then on the right-hand side, the differences with investing. I would highly recommend you pause the video right here and copy this into your notebook. So here we have on the left our savings and our investing. There are 5 main ways that they differ: return, risk, liquidity, the time horizon, and what kind of goals that they're suitable for, and their volatility. I've created a little acronym to help us remember those 5 key differences. Red, R, roses, R, love, L, teal, T, vases, V. That stands for return, risk, liquidity, time horizon, and volatility. And I've created a little picture, because sometimes when you picture something, red, roses, love, teal, vases, that helps you to remember those 5 key differences. Well, I hope you've learned a lot today in our video. Thanks for listening.